Welcome to accounting class. We continue with cash flow statements. But today we want to discuss the difference between cash and profit. Cash is not always going to be the same as profit, and the reasons behind this is going to be explained further. Cash doesn't always equal to profit. This occurs because some transactions will affect cash but not profit. So there are some transactions, they're going to affect cash but they would not affect profit. And what are those kind of transactions? The following best illustrate the above statement. Number one, the purchase/sales of fixed assets. This will increase or decrease cash but does not affect profits. The purchase or sale of the fixed assets would not affect profit but would affect cash. Why? Because the purchase of a fixed asset or the sale of a fixed asset is recorded as capital, and that is recorded or treated in the balance sheet. So which simply means it does not have anything to do with the profit and loss account, and that is why it's not going to affect profit. So capital items are recorded in the balance sheet, not in the statement of profit or loss. So that is why it's not going to affect profit, but it will reduce your cash. And as soon as the purchase of asset is done, the asset of cash reduces and the asset of equipment or machine increases. So it does not affect profit, it would rather affect cash. The second one, the introduction of capital or drawing. The introduction of capital means the owner of the business has simply injected cash or money into the business, and that will be treated as capital based on the principle of entity, where the business will be treated separately from the owners of the business. So as soon as the owner of the business injects cash into the business, it is treated as capital. Or whenever the owner of the business takes money from the business, it is called drawings. So capital or drawings would affect cash but not profit, because both will be recorded in the balance sheet, not the profit or loss account. The third one, loans received or repaid and investment bought or sold. When loan is received, it affects cash, not profit, because it's going to be part of the non-current liability. And when loan is paid, it's going to affect cash. It's going to affect cash, not profit or loss, because a loan payment or a loan received is part of the balance sheet. So it's not going to affect profit, it would rather affect cash. So the amount will increase or decrease cash in the cash account and the balance sheet, but are not treated as expense or gain. So when a loan is received or a loan is repaid, it does not affect cash. It would rather, because it's going to be used or treated in the cash account or the balance sheet. Then non-cash items. For non-cash items, they would rather reduce profits but do not affect cash, because we call them non-cash items. They do not affect cash, rather they affect profit. So I wrote, non-cash item increases or reduces profit with no effect on cash flow. A non-cash item would not affect cash. Example of a non-cash item is an increase or decrease in provision for bad debt. It's a non-cash item. Depreciation is a non-cash item. So these ones would not affect cash, but would affect profits of the business, because they are recorded in the statement of profit and loss account and other comprehensive income. So that's about cash and profit. Now we're going into cash and non-cash items. Why do we call them cash items and why do we call them non-cash items? And what are the implications when it comes to profit and cash? Non-cash items in the profit and loss account affect not net profit, but they don't change the cash situation. So for non-cash items, they do not affect cash because they cannot change the cash situation, but they affect profit because they are treated as either income or expenses, and it is recorded in the statement of profit or loss account. So for cash and non-cash, we have cash gain, we have cash expenses, we have non-cash gain and non-cash expenses. I'm going to say that again. We have cash gain and cash expenses, we have non-cash gain and non-cash expenses. So how do they affect cash and profit? For cash gain increase both cash and profits as it involves sales of goods and services. This is what the business does. So for cash gain, this is the trade of the business, the trade of the business. So whenever there is a cash gain, it simply means the business makes a gain. And when the business makes gains, it increases the cash and at the same time increases the profit. So cash gain would increase cash and profit. Then the next one is cash expense. For cash expense, it means the business is spending on maybe wages, salaries, overheads or operating expenses. This would reduce cash and reduce profit. So for cash expenses, this decreases both cash and profit as it involves wages, salaries, and other operating expenses. Expenses reduces the profit. Expenses takes away cash from the business. So it means cash expense would reduce cash and reduce profit. Then the next one is non-cash gain. For non-cash gain, it is more like an income for the business, and it increases the profit, but not the cash. Example is it increases profit but not cash, as both reduction in provision for bad debt or profit from sales of assets is recorded in the profit or loss account. So as soon as there is a decrease in provision for bad debt, it will be recorded on the credit side of the profit or loss account, and that is treated as an income, and that increases profit but does not increase cash system or cash situation. Non-cash expense. For non-cash expense, it reduces profit but does not have anything to do with cash. It decreases profit but not cash, as increase in provision for bad debt. An increase in provision for bad debt will be treated as an expense for the business, and that reduces the profit of the business. Depreciation of fixed assets. Depreciation of fixed assets is also treated as an expense. It does not affect cash, so it reduces the profit. So in summary, cash gain increases cash and increases profit. Cash expense reduces cash and reduces profit. Non-cash gain increases profit but does not have anything to do with cash. Non-cash expenses reduces profit but does not have anything to do with cash. So these are the difference between cash and profit. Thank you.